All right, the Federal Reserve just made a move that's going to ripple through everything from your mortgage to your 401k. They've cut interest rates again. So today, we're going to break down what just happened, why it's a much bigger deal than you might think, and most importantly, what it means for your money. Let's get right into it.
So here it is, the headline number that just sent shockwaves through the markets. The Fed cut its benchmark interest rate by 25 basis points. That's a quarter of a percentage point. And the market's reaction? Oh, it was immediate. Stocks just shot up right after the announcement, and the S&P 500 came this close to hitting a brand new record high. So what exactly did the Fed cut? It's something called the federal funds rate. Now, the easiest way to think about it is like this. It's the thermostat for the entire economy. The Fed turns this dial up or down, and that changes the cost of borrowing for pretty much everyone, affecting everything from car loans and credit cards to, of course, mortgages. With this latest move, the new target rate is now sitting in a range between 3.5 and 3.75%. But here's the key thing you got to know. This isn't some random, one-off event. Nope. This is actually the third time they've cut rates this year, so we are definitely seeing a clear pattern emerge.
So that begs the million-dollar question, right? Why now? On the surface, the economy seems, well, okay. So why the cut? Well, it all comes down to the Fed's incredibly tricky balancing act. You see, at its very core, the Fed is legally required to juggle two goals that often pull in completely opposite directions. It's what's known as their dual mandate. On one hand, they have to push for maximum employment, but on the other, they've got to maintain stable prices, which for them means a 2% inflation target. It's a constant, high-stakes tug-of-war.
So what tipped the scales this time? Well, a few things. First, the job market. While it's still pretty strong, it is showing some signs of slowing down. Second, inflation is cooling off, but it's still running a little hotter than that 2% sweet spot. And really, the big idea here is to pull off a soft landing. Gently tap the brakes on the economy to get inflation under control without, and this is crucial, sending us spiraling into a recession.
We actually got a huge clue about what's next, straight from the man himself, Fed Chair Jerome Powell. He basically came out and said they're going to hit pause for a bit and see how things play out. But the real headline was this. He said a rate hike isn't even being considered right now. For the market, that is a massive, massive signal.
Now, you might think a decision this huge would have everyone on the same page. Well, you'd be wrong. And this is where the story gets really, really interesting, because behind the scenes, the Fed was a house divided.
The vote wasn't even close to unanimous. You had 9 members who voted for this quarter-point cut. But you had 2 members who actually wanted to keep rates exactly the same. They're probably still very worried about inflation. And get this, 1 member wanted to be even more aggressive and cut by a full half point, which signals they're way more afraid of an economic slowdown.
And just to put this into perspective, this is the most divided the Fed has been on a vote in years. We're talking about a serious disagreement among the very people who are supposed to be steering the U.S. economy.
So you have to ask, when the experts at the very top can't even agree on the right path forward, what does that signal for the future of the economy?
Okay, so let's bring this down from the 30,000-foot view. Let's talk about the ripple effect. How does a decision made in a boardroom in Washington, D.C. actually hit your wallet?
Well, Wall Street's initial reaction was pretty positive. You can see the immediate jump across all the major indexes right after the announcement was made. They clearly liked what they heard.
It's also having a huge impact on the housing market. As one source noted, sellers are having to get a lot more realistic. The typical U.S. home listing saw cumulative price cuts of $25,000 in October. That matches the largest discount Zillow has ever recorded.
And beyond stocks and housing, it's really a mixed bag out there. Gold, for example, is having a solid year. But then you look at Bitcoin. After a pretty crazy ride, it's actually on track to end the year with a loss. But hold on, there is another way to look at this. A rate cut isn't always good news. Historically, the Fed doesn't cut rates unless it sees some real trouble on the horizon. So the real fear isn't the rate cut itself, but the underlying economic problems that force the Fed to act in the first place. Which, of course, brings us to the big question. What's next? Let's take a look at the Fed's own forecast to see where they think the economy is headed in 2026.
All right, looking ahead, the Fed's own projections are kinda surprising. After 3 rate cuts this year, they're forecasting only 1 more for all of 2026. That's a huge slowdown. At the same time, they're actually expecting the economy to grow a little faster than they thought and for inflation to keep cooling. But, and this is a huge but, there's a major catch to all these forecasts. A recent government shutdown meant that key economic reports on jobs and inflation were delayed. So the Fed is making these critical decisions with incomplete data. As one official said, it's like trying to drive with a foggy windshield.
So that leaves us with the big question. With the experts themselves totally divided, and the data they need to make decisions incomplete, is the Fed successfully guiding us to that soft landing, or are they flying us into even more uncertainty? That, right there, is the multi-trillion-dollar question hanging over the economy right now.